Today on the show, I have the pleasure of chatting with an absolute legend and a really good mate of mine, Ryan Parker. Now, Ryan is a real estate debt broker with Walker Dunlop's Capital Markets division based in Irvine, California. He's just down the road from here in Los Angeles. Now, he started his career as an industrial tenant rep in Los Angeles before transitioning into the real estate capital markets. When he's not working, he's riding his horse through Griffith Park, or he's at home with his wife and young daughter, or hiking and fishing somewhere in California's wilderness. I'm really excited and pumped to have him on the show today to share his incredible knowledge with us. But enough out of me. Let's get him out here. G'day, Ryan. Welcome to the show. How do you today, mate?
Hey, Reed. Thanks for having me on, man.
My pleasure. Now, for everyone mate, you provided it. I just repurpose it. Make you sound good. So, for everyone who's not aware of you, you and I have been really good friends for a couple of years now. We've actually been horse riding together. But this is your first podcast ever, podcast appearance ever, which hopefully is going to be the kickoff to some lucrative career in the podcasting world, that you're just going to be the go-to guy for capital markets and debt advice because, as we know, investing in the US goes around to millions of listeners. But I say it all in tongue in cheek because I'm really excited to have you on the show. I do value your opinion. And for everyone who's listening out there, Ryan is an integral part of the team here at RSN. He is a go-to advisor in terms of everything to do with debt. If you are interested, we'll have all the show notes and his contact at the end of the show. But Ryan, let's get into it. Before we get into the nuts and bolts of what you're seeing in your crystal ball here in today's market, can you rewind the clock and tell me how you made your first ever dollar as a kid?
My first ever dollar as a kid was made as a horseshoer's apprentice in high school. So I worked 3 to 4 days a week in summers, putting shoes on and off horses. And that taught me that I wanted an office job because it is hot in Southern California in summer. And I really loved it, but taught me that I definitely wanted to get into a nice place like this.
And for those people listening, it's not literal shoes like tying with shoelaces. It's the metal thing that goes on the bottom of the hoof. I also spent back in high school days as well at a thoroughbred racing spelling complex in Australia on the holidays, between prepping horses for what's called the Magic Millions in Australia, which is the young colt yearling sale in Australia. It's one of the biggest horse breeding in the racing industry in the world, I believe. This particular stud had prepped horses for it, and I spent time doing everything, including being an apprentice with shoeing. Shoeing is backbreaking work. So but awesome. Yeah. Well, mate, walk us through the transition. Horses to shoeing to now you're in the capital markets, completely different world. How did you get there?
So I say I slid into capital markets backwards. I started university wanting to first be a marketing major for General Motors. I thought I was going to market Cadillac to the world, and then I decided I didn't want to do that and got into real estate. So I actually entered the real estate world after, at age 19, and started learning how to sell industrial real estate. That was kind of where it all started. And after that, after college, got into full-time employment as a broker, as you had mentioned, industrial tenant rep in the San Fernando Valley area, specifically of Los Angeles. And in that, really learned, I think, the fundamentals of what makes good real estate. And that to me is like far more important than what the numbers do. And now that I've learned the numbers more effectively, we all know that you can make an Excel model what you need it to be, but at the end of the day, you're still buying a real asset that is or isn't a good investment. And so being able to understand properties at the property level was really beneficial to me. And so after a couple of years of really learning that, I got into capital markets in Century City with a boutique firm there. And after a few years there, really learning the capital markets and the debt side, and moved into Walker and Dunlop about just over 5 years ago now, and have been here since. And that really launched the national platform that I'm working on now. So. Yep.
Yeah, that's great. And we actually have not had anyone on the show in all its history actually talk about industrial. So just for 30 seconds here, high level, You mentioned buying good real estate in the industrial space. What does that mean? Is it close to ports? Is it population centers? Like, how are you looking at it in terms of buying good dirt? Because I know in multifamily, we know how to buy. We've talked about this on this show a lot. You've got to buy with certain household incomes. You want to buy in path of progress. Close to transportation hubs. Is it the same with industrial?
Yeah, so I have a very unique perspective on industrial because it's Southern California based. So I'll always have the port of Los Angeles and Long Beach, ports of Los Angeles and Long Beach as like this anchor point. So there's really no bad investment in the greater Southern California basin for industrial in that regard. But from like a 30-second, what makes good industrial is generally proximity to major transportation thoroughfares across the United States. So whether that's major highways, major ports, major rivers, et cetera, you name it, a major railway is another key thing. That's going to help because a lot of distribution, whatever you need is going through a distribution channel, whether you're making something or distributing something, it needs that. So that's really important. And it can get as granular as multifamily. At the end of the day, it's a concrete cube, and how tall you build it and what goes on the inside changes. But and so I could pontificate on that for 20 minutes in terms of what you want to look at. My personal standpoint, my bread and butter, my favorite industrial asset class is multi-tenant industrial space with the average tenant size under 15,000 square feet, because it runs a little bit more like an apartment. Your tenants tend to be a little stickier. You can have a diverse tenant mix that allows you to protect against any potential market risk for any one particular vendor or tenant. And so that's if it were me and I were starting a fund to go buy industrial, I'd let all the big guys keep doing what they're doing, and I'd go chase the quiet cinder block built stuff around all across the country that stays consistently occupied.
How is it in now? You got me intrigued. You mentioned tenant rep, right?
Right.
I go to a property management company and say, hey, fill up my multifamily. You're going to go online. People need rentals. People needs a bed, a roof over their head. In the industrial world, it must look different, right? You got to go direct to businesses. It's a B2B sort of space, and making sure you're putting the right quote unquote tenant in there. That's right. And what's the risk of them getting up and leaving and moving out and paying the right rent? And you're probably looking at longer term leases. So how does that sort of, again, I don't want to delve too much into it, but like how does that work from make sure you're filling up the space in a timely manner to reduce your risk if you're buying something, particularly if it's a value add sort of space like you mentioned, a cinder block, mum and pop owned type of space.
So how to fill it up quickly? I mean, it's always just the lowest lease rate seems to always attract people, but that's not always the best business decision. Industrial sells itself relatively well just because it's something that people need, businesses need. So as a tenant rep broker, at least in California, we have what's called dual agency, which will allow a real estate broker or real estate agent on the commercial side to represent both the landlord and the tenant on the same transaction. And so I carved a niche for myself by focusing on just tenant side, which in industrial in our market for a long time was kind of unique, at least on the ground level, street level. You want to go corporate services, it's very normal to have a CBRE, JLL, Cushman, name it, rep Coca-Cola across the country. And so that's normal. But to have someone campaigning for the 2,000 square foot cabinet maker or the precision machining guy or the small distributor of Amazon products was different. So I made a name for myself doing that. And how to get the tenant mix in is really what your building will dictate 9 times out of 10 who's going to move in. If you have lots of power, you're going to get a lot more manufacturing. If you have higher ceilings, you're going to get more distribution. If you're on a signalized intersection and it's all right turns into your property, you're going to get more distribution because it's safer for your truck traffic. How deep your courts are, your truck courts are, is going to make a difference. And also just what do people need in the neighborhood? If you're looking at something like a smaller mom and pop type multi-tenant industrial space, what's in the area? Is there enough housing to support the kinds of people that are there? Or do you have a lot of smaller kind of, call them third party vendors that support a bigger facility down the road? So, like a simple example would be in the San Fernando Valley, it was an aerospace industry market for the longest time. So you'd have Lockheed Martin, Boeing, and Glen Air is another really large aerospace manufacturer. that were out there, and they would need smaller companies for overruns if they needed to create a lot of product quickly or a specialized product. So you had a lot of that support. So that's kind of what drives it. But I mean, I can go into more detail. If you want.
It could be a whole podcast in its own, and we might need to get you back because I haven't actually covered industrial. We covered self-storage a lot, but industrial has definitely been the sort of the new girl on the block, so to speak, coming out of the reset, not reset, coming out of COVID. It was multifamily and industrial. Everyone seems to be flocking to that as people are staying at home. Are you still seeing that being the belle of the ball right now?
Industrial, I absolutely think industrial and multifamily are still the belle of the ball. Industrial was the dirty little secret that everyone in the industry knew, but like Wall Street still was like, yeah, it seems cool, but I don't know if we're there yet. It's a concrete cube, as I said, and turnover on the simplest degree is really just sweeping the floor and putting a fresh coat of paint and carpet, and that's technically like the bare minimum you could do to turn an industrial building. There's obviously a lot more to that, and so I think that's when everyone realized that this is a simpler puzzle to solve and a simpler asset class to manage per se than a 300 unit multifamily property where you have 300 individuals that are living there and have it's a personal decision on some capacity for your tenant mix in an apartment because it's their home, and it's a business decision in industrial. But yeah, industrial is still the belle of the ball. It's still, I would say, from what I'm hearing, and I'm not in it day to day like a true industrial broker, but everything I'm seeing from the capital side and what all my friends and colleagues and clients in that space, and what I see, I would not describe industrial as hot as the sun anymore, but you're probably somewhere around Mercury or Venus in terms of your exposure to the sun. I mean, it's still extremely hot. It's a little cooling right now, but cooling, but still hot to the touch is what I'm trying to say here. It's still an incredible place to go invest.
Well, it's a good segue because I think a lot of things are cooling, right? Well, let's get into the debt markets right now. So maybe give us your 30-second take on. We did a whole state of the webinar last week with RSN, and it was our opinion on where the markets have come from and where they're headed. But give us your close to the coalface in terms of producing debt, originating debt on a wide slew of different product in the commercial world. How has this year been in terms of just momentous swings away from the sun, so to speak, but in the bells of the balls of like the multifamilies and the industrial spaces of the world?
Yeah, so I would say that this year's been wild. It started off with a bang. Everyone was energetic, and then obviously with inflationary pressure, instability geopolitically, the world changed dramatically. But from a 30-second standpoint, to summarize this year and call it the next 24 months, we're facing instability in the market because we don't know how bad inflation is, and we don't know what geopolitical influences are going to have on the world. Rates have spiked because of that volatility and the perceived risk within just the overall markets. And because of that instability, there's also indecision because people are waiting for stability to make a decision on how to move forward.
Yeah,
my gut tells me, and what I'm seeing everyone, and what I'm kind of hearing, we're all really hoping that the second half of next year is going to be when it all just takes off again. It's not going to be 2020. It's not going to be 2021. If you're trying to make your business decisions, assuming that rates are going to be at zero again, that's probably not the best thing to do, to put it politely, because that was a once in a lifetime catch, and people made a lot of hay when they could, but that's not normal. So you should not drive your business decisions assuming that will return.
No, it has been very interesting to see this momentum swing away from just how hot a lot of spaces were. Obviously we're deep in it with multifamily. How you're getting sub 3 caps going in, but you're getting debt at 3.5 caps. So it sort of really made sense. And now we're expanding so much. You're going a Fed rate of from 0 to nearly, probably it's projected to be over 5% next Q1 next year. That's a 5-fold in less than 12 months. It's going to have a massive impact, right? It's going to be a big handbrake on the market. So you mentioned earlier about, just uncertainty and instability. I know I talk a lot about we as investors, we can make money in any market. We just need to know the rules. And I think that instability is coming out because we don't know the rules, right? So how are you hearing from other operators and brokers? Is it quiet out there? Is it stagnant? Are deals just not getting done because seller expectations and debt markets just aren't aligning? Thus, deals aren't you're either got at a good basis and you're holding, or are you still seeing deals getting done and they're just getting done because of panic, or because of that people are starting to get underwater, so to speak?
Right. I haven't heard much on the underwater side of things. I would say, to instill confidence in everyone listening, the market's still very liquid. There's a lot of cash in the system on both the investor side and the capital side. So we at this point are not seeing a liquidity crisis of the likes of 2008. So that's a really positive thing. And also underwriting parameters in general have become far better than they were that what led to 2008. So, and the great financial crisis. So that's a positive. Deals are still getting done. It's still a very busy market. I think where deals have shifted is that the refi business, where someone signed a deal up at 5% 5 years ago and they can take it out at 3.5%, call it the beginning of the year, that's gone. Obviously, really rates they're high, but they're not wildly different than where we kind of saw what some people felt the high water mark was within the last 20 years. I mean, we've seen deals that had 7 coupons and 6 coupon rates, 5.5s, and frankly, the market can operate healthily and really well with interest rates, all-in interest rates on long-term fixed rate debt somewhere between 4.5 and 5, in my opinion. I obviously want to see it lower, but that's very reasonable. We're still in this pricing discovery mode. You're seeing it with RSN as you're out competing on deals. Other people are seeing it too. There's sellers that still think they can get the same price that they got at the beginning of the year right now, when even though the cost of capital is up truly exponentially, and that's unrealistic, and that has to change. And I think it will change, just because if people want to transact, then they have to adjust. The transactions that are occurring now are I'd say a lot of 1031 investors that need to deploy capital because they've sold an asset and need to put it somewhere and want to avoid tax ramifications of that. Also, on an institutional level, a lot of funds that are out and are required to deploy capital by the end of the year, or are required to put out a certain amount of money, are driving volume as well. And there's still some opportunities out there. It's not to say that the market's toast and you can't find opportunity. I think there's plenty of opportunity. It's just harder. It's been easy. I hate to say it, but the last 5 to 6 years has been really easy in the capital markets, and in investing in real estate. So you have to really show how you're going to add value and not not be the 5th guy in 4 years to buy the value add piece because the first guy did 10 units, improved it, and upped it $25K a unit, and the other guy did 25. You've seen that, Reed, and so I think that's where the market's headed is in a really positive direction. It's scary right now, but overall, it's going to be positive.
Are you seeing people shift away from the floating rate, high octane stuff into fixed rate product?
More so, yes. That's a product of a couple of things. Rate cap costs are still really expensive. For listeners that don't know, you pay a certain dollar amount to cap what your interest rate will be on a floating rate loan. And because the yield curve is still pretty aggressive through at least the middle of next year, that cost is high. So you used to get the pricing benefit of, I'll take floating rate and it might be a little less, maybe a little more, but I got the flexibility. There's a lot of pieces of that puzzle. But now you're paying 1.5% to 2% on a 3-year loan to just cap the cost of the loan. So add that to your starting. Your blended cost of capital increases that way. There's also less floating rate debt in a way, because when this level of instability, a lot of the floating rate lenders that competed with lines of credit and warehouse lines, and not basically having some of their own money, using that money to get a levered line to then borrow more and deploy more, those lines are going away. Excuse me. And so unless they have a really strong balance sheet, they're kind of hesitant to enter the market. So that's one of the reasons why there's just less floating rate debt out there, is there's less floating rate out there. So that kind of happens. And a fixed rate product, it reduces your leverage standpoint, but it's predictable. And I think that's what people want right now. Everything seems so unpredictable. So if I can at least have a predictable debt, cost of capital for the next 2 to 3 years, so be it. I have to raise a little bit more equity, but I know what my return's going to be. And I think that's making people more comfortable.
Yeah, I completely agree. And as we're looking at deals in real time right now, we're only looking at fixed rate debt. And you've obviously been looking at a ton of stuff for us and just trying to adjust the seller's expectations of what we can pay for. And I think we're still hot and heavy on the value add space. But I talked a lot about arbitrage, and you're probably seeing a lot of arbitrage as well between like what's your going in cap rate versus interest rates. And probably historically, you could allow for 50 to 75 bips because you believed in your business plan. Today, with the increase, you can't sell at a 4 cap and try to get rates at a 6.5 cap. It just doesn't work. The business plan doesn't work. You need it to readjust. So, very, very, very interesting. What I wrote down here, and one of the cardinal rules that we do here at RSN is we've never underwritten to a refi. Right? We want it up the sleeve if we can have it, but we've never done it. Over the sort of 7-8 years I've been in this business. Never done it, but have executed on it, and it's just the ace up the sleeve. Given where the debt markets are today, are you seeing more people coming in at that lower leverage today and then knowing and having confidence that the capital markets will be different in 2 to 3 years, thus justifying a refi scenario in their models? Is that changing at all for you in the conservatism, not conservatism? Because we are, I'm seeing leverage points at as low as 50, 60%, on some deals. It's like, I know, and if I believe in the business plan, I know I'm going to be able to improve that value. Thus, I want to go capture some of that value. And to your point earlier, like you might just have to saddle up with a fixed rate debt today. You're raising more money, but is there an opportunity down the line? And do you believe personally that there's an opportunity to come in and do a refi in 2 or 3 years' time because we will be a little bit more quote unquote stable in the market and we understand the rules to play by?
Absolutely. I think one of the things that, I'm trying to figure out how to phrase this appropriately here. Short of it, I need a minute here. I want to make sure that I process it correctly. I think that refi business is always a good part of your analysis, and it's good to hear that you're doing more of it. And part of that is that's a downside risk analysis. So if you can't sell it at the price at which you think you could because cap rates have blown out, which we're kind of seeing now, then it's good to have, the refi opportunity available. So it's nice to see that people do that. I think more people are looking at it, and yes, certainly there's a lot. I'm hearing a lot more people trying to put their cart on the horse that believes rates will decline in the next 2 to 3 years, than stay stable. So is that kind of processing a little bit?
Yeah. No, it's just an interesting, between different operators. I just don't know if you're seeing models come through on your desk and say, "Hey, Ryan, I want to get the 50 or 60% leverage today because I'm just trying to back into the lowest interest rate fix possible, but right. I am planning to." Get these local, credit lenders out or the local banks out in 2 or 3 years' time. And my business plan is to try and get, from call it a 6 fix today. I'm hoping it's down to 5.25 in 2 years' time. And I can pull out maybe 10 to 15% equity, right? To bring my leverage back up to sort of a, call it a 65% leverage, typical of what you've seen prior to sort of this year. That was sort of the question. Is more of that coming across your desk?
Yeah, definitely. I think that more, and I also think that's because the market is in a position now where we're not just riding the wave anymore. Like the value that you're adding is actual value. Not that you weren't before. Not that, and I'm not saying you specifically, but the market in general. People in the value add space could demonstrate a little bit about added value. Then it would be overbid, knowing that there's even more future value and more and more and more. That's kind of stopped, at least for what I'm seeing, and I sense what you're probably seeing as well. So now people are like, okay, let's see let's go ahead and move rents to just market to where they are today, and that can be our value add, and not assume that we're going to get 20% rent growth for the next 3 to 5 years. Maybe we pop it 10 to 15 the first year, and then 3 to 4 each year thereafter. And that's a little bit more realistic. And so that is true added value, because at the end of the day, you are increasing net operating income. And as long, and if you believe that cap rates are going to stay where they're at or even increase a little bit, you're going to make up for it in value just by the fact that you actually did create more cash flow for the property and didn't just upsell it at a greater cost, cost per unit, because that's where the market was at the time. So I think that in that, you will inherently get good refi debt because your cash flow is improved. So if you're taking your cash flow from A to B and B is higher than A, you're going to get more. You're going to get better capital. You might not even increase your LTV. Technically, you could still go from like a 55 to a 55 LTV, but it's just that the value of the property's increased. So you're not having to go from like 55 to 75. If right. That makes sense.
Yeah. What are you seeing in those guys that locked in rates, 2 years ago, and at a certain leverage, maybe high octane, and then trying to come and refi in today's market? Because there must be some blood coming. Yeah,
there should be in some way. Yes and no. So the guys that went ahead and got a LIBOR plus 275 loan 3 years ago or 2 years ago when LIBOR was 18 basis points, and now LIBOR's, we're at SOFR now, and SOFR's, I think, pushing 4 today. And their underwritten exit rate was, 375. They're going to run into some issues. But if they've added the value, I think there's an opportunity for a refi. They also have, a lot of these people have extensions on their loans. So that's going to help. I guess my gut on it is that yes, there's certainly going to be some opportunity for distressed assets. At any point, there are those that got too aggressive, missed the business plan, and were over their skis, and now have to throw the keys back, which is, lender takes the property back because there is no other way to solve to that, or they're going to sell the asset before it gets to that point and just take a break even or a little bit of a loss, so that way they're protecting their reputation and not having to be known as someone that is willing to default and foreclose on a property. The financial markets, at least from the banks that I've talked to and others, they don't want to do that. At the end of the day, most lenders don't want to have to take the keys back and process that. So from it's going to be 2008 again, and there's going to be all this bank-owned real estate and lender-owned real estate, and where they're going to offload it on fire sales, my gut tells me that's not going to happen, because everyone did that at the last time and they really hated it. It is a process to do that. And so if they believe that, if everyone believes that the second half of 23 is going to start things off again, and that markets are going to stabilize, they're going to do the best. Lenders are going to do the best that they can to not do that. So whether that's a loan modification, an extension, you name it. I mean, I'm working with a client right now that he's moving from a fixed rate product to a floating rate product because there was a 5-year fix that moved to a float, and his cost of capital is going up by 300 basis points.
Wow,
and that's substantial. And none of us could have planned for that 3 or 4 years ago. But now I'm here helping him, and the bank is saying, you know what? We don't have to move it to amortizing and at the higher rate. I mean, it'll have to move to a higher rate. We won't amortize it. We'll give them a couple years IO, help them weather the storm, and hope things will stabilize again. And that's an example of a bank that very easily could have said, deal with it. Pay me my money, and if you can't, give me the keys, and we're going to go sell it. They're looking at it too and not going, well, if value has decreased, then we're going to take a loss. So why not just keep getting that return? Not exactly how we wanted it. Why not keep getting that 6% interest rate now, or whatever 5% interest rate now, and riding that for a few years, and then seeing where the situation is.
That's interesting you bring that up, because I think rates have shifted so much. Cap rates have shifted, thus values have shifted, and real estate is not a stock ticker. But if it was, you could argue that what you bought 12 months ago isn't worth what it is today. Right, which means you're underwater. Yeah, and so you just walk people through that and how the banks see that, because it isn't a stock tick. They're not saying, well, today you're worth less than what you bought it 12 months ago, and that's not necessarily your fault, because it's all tied into how quickly you can increase the business plan. You mentioned earlier, you got to go add value. Well, if interest rates have risen five times in 12 months, I know you can't implement your business plan that quickly. So there has to be, and what I'm hearing is that there has to be a little bit of give and take there. Like lenders aren't being like, we're going to smack you over the back of the head. You bought too high. The market's now shut the bed. It's now worth less. Yeah. It sounds like they're wanting to work with people in order to just like, let's ride it out together. Let's take a breath. And we know we're all in this boat together. So let's not panic.
Yeah, definitely seeing that. And in the sense that as cap rates move, you have obviously the near change in value. And so you have $1 million in NOI at a 4 cap, it's going to be different than at a 5 cap, than at a 6 cap, than at a 3 cap. We all get that. But that's if you're going to transact and you're actually looking to sell the property. To me, at least in my viewpoint, and I'm pretty simplistic in this way. If your net operating income can still service your monthly mortgage payment in the short term, great. As a lender, I'm like, fantastic. This isn't exactly what I wanted, but if you can still pay your mortgage every month, then that's a positive. And if you can't, let's try and figure out what we can do to solve around that, rather than immediately go default, foreclosure, keys, fire sale. Sorry, no one wants to do that. At least I can't say no one. They're out there, and there's plenty of them, and I get it. But the sense of it is that there's a lot more, as you said. Let's come alongside and work together, so that none of us have to deal with the worst case scenario.
Awesome. Yeah, look, well, I could talk to you for hours, honestly. We do as friends. But the one question I wrote down here is, I know Walker Dunlop has an incredible platform of their own. Yeah. For those listeners out there, Walker does their own podcast and have got into the sort of the podcasting realm, and they interview some really big heavy hitters. But what are you hearing internally? Obviously, you don't have to tell us any secrets, but what are you hearing on your internal calls about the market, the war, inflation? Coming into 2023, what's the big dogs talking about on these phone calls?
Right. So you can certainly listen to, we have it recorded, Walker and Dunlop's third quarter earnings call will give you a great perspective on how our CEO, Willie Walker, is looking at planning for the future, what his anticipations are and expectations are. And so that's going to be a really good piece of color there. Like anyone in the commercial real estate industry right now, things have slowed down, and that's no secret. Volumes are less, and what's that look like? Internally, we're not panicked, we're not scared. You can see our servicing portfolio that we have good income, we have good cash coming into the company. So from like a corporate Walker and Dunlop standpoint, there's not a lot of panic. That being said, any leadership needs, obviously has to prepare for the worst and hope for the best. So there's always going to be those analyses of, okay, if we don't get that stabilization in the second half of next year, well, what's that look like? So there's certainly planning for that. But overall, I can tell you that at least internally at Walker and Dunlop, things are extremely optimistic. We're still doing well with our overall volumes. If I remember correctly, I think our 2022 year to date is somewhere like in excess of $30 billion in transaction volume, I believe, for the third quarter, if I remember that correctly. But again, I can send stuff after the fact for you to send to your listeners so they can see. So volumes are off, but that's because they're off of where we were at the January 2022, where everyone thought things were going to continue in that pattern. So of course there's going to be a natural transition, and that happened. But yeah, internally we're optimistic. Our investment sales platform still really busy, doing a little bit more BOV work right now than they did before. Which is broker opinion of value for those that don't know. That's normal when things start to slow down. People start to reassess, hey, what is my property actually worth now? Does it make sense to make a sale? We're doing a lot of refi analysis, believe it or not, even though I said that market slowed down. Part of the reason why is that with yield maintenance and defeasance prepayments, those were expecting a certain return at a certain coupon rate. And now that interest rates have risen, it's dramatically reduced people's prepayment penalties on those loans. So there is some motivation to go, hey, could I get some cash and maybe take a little hit now to keep that dry powder if the market were to really turn, or reinvest it as things start to ignite again. So overall, we're really optimistic with where the future is. Obviously, we're kind of looking around and like everyone else, but positive. very positive.
And that's optimistic, not only just from Walker Dunlop's perspective, but from the economy's perspective as well. Is that right by saying?
Yeah, I would. I mean, personally, again, I'm not an economist. You can listen to Lemon on the Driven by Insight podcast. He'll tell you what's going on, and what his thoughts are on that. But from an outsider looking in at like the global economy, right, which is something I am not paid enough to. I'm not even paid to do that. I'm paid to broker debt. I'm not paid to pontificate on the global economy. But I can tell you that with that, the last week has shown us, I think, what's going to happen. You saw CPI go from, or inflation go from like 8.4 to 7.6, I think was the exact number. But you saw a decrease, right? We're still in an inflationary world, but it's not as high as it was. And the markets responded resoundingly well. Everyone was like, let's go. Treasuries drop, markets are up, Dow's, like mid 30,000s again. Everyone's fired up. Now, granted, things are kind of climbing back, but I think that's just more of an indication that we're all waiting. Like, there's all this cash, and everyone's sitting here waiting for the Fed to slow down their rate hikes and go, okay, let's sit flat for like 6 months. And everyone's going to go, great. We know what it is. Let's make a run at it. So that's my sense, is that everyone's waiting by the sidelines with a lot of cash in hand to get back in.
Yep. Get the rules of the game understood. Or see some freaking forest between the trees, the trees between the forest, whatever the way to talk about it. But just get to a point where we know where we're headed, and we see the light at the end of the tunnel, and we understand the rules to play by to go out and start making sandcastles in the sandpit. So, with that being said, my friend, let's dive into the top 5 investing tips. You ready to get into it?
Ooh, okay, yeah.
It's 5 questions. Semi-lightning round. You're unprepared for this as your first podcast ever episode recorded. You're doing freaking fantastic.
Thanks.
Question number 1 is, tell me how you keep on track. What's a daily habit you practice to keep on track towards your goals?
I just started something that I call the 5 a.m. club. And so want to make sure that I'm up at 5 a.m. every morning, and I get kind of reading and prayer out of the way. And not out of the way. That's actually a really important thing to help center my day. It reminds me of my perspective on what I want out of this life and how to get there. And then that helps me start every day fresh, clean, and focused.
Love it. Question number 2 is, who's been the most influential person in your career?
Ooh. Wow. Most influential person in my career. I've had a lot of people that have influenced me from, I'm going to name drop here, just shout out some of my favorites. Like Cameron Merrill took me on at CBRE, took me on my first cold call at 19. Let's see here. Gary Tenzer at George Smith Partners given me a chance to even get into the capital markets as an industrial broker. And then even where I'm at right now, my senior partner, Greg Richardson, believing in me and supporting me and doing what he can to be successful. So, those are the guys that have been, the people in my life that have been really influential on helping me grow and taking a chance on me. So, that's
awesome. You got to have people to take a chance on you, right? Particularly when you're starting out green, and shout out to the boys there. So, well, hope they will get a listen to the episode, and tell them to listen to minute 38, and they'll get a shout out. So.
Exactly. Yeah, listen to nothing else. I did really, really well in the lightning round.
Exactly. Question number 3 is, what's the most important tool that you use in your business? And when I say a tool, it could be a physical tool like a notepad, which I can't run the business without, or it could be a piece of software that you can't run the business without. What is that influential tool in your business?
Gosh, obviously Excel. That's the obvious answer, right? I'm in finance, so Excel is pretty important. But from a standpoint outside of that, the big name Salesforce for that. But like a simple tool that I use every day is, I also have a notepad or a to-do list, and I write down the people that I need to make sure I call by the end of the day. And something as simple as that, and making sure that you follow up in that capacity really helps. Commercial mortgage alert for people, if they're curious about some literature. Commercial mortgage alert is something that we get weekly that gives you an idea of kind of where Wall Street's head is at on a lending standpoint, and that's really good to know and really good to have. Go ahead and hype the Walker webcast, Driven by Insight on Spotify. That's a great way to kind of just get luminaries from all sorts of areas. And And then again, something a little bit more proprietary as well. Internally, we have a lot of technology that allows us to analyze real estate on a very, very deep level, which has been fantastic. And it's something that I use every day when I help consulting clients in terms of how to look at refis versus hold scenarios, expense comp for you in multifamily. We've got like 2 million units in our servicing portfolio, I believe, and that's all data that we can use. So that's really powerful stuff. And but for the common person that doesn't have access, I mean, not common person, but just for people that don't have access to what I have at Walker and Dunlop, remove all of the talking heads, remove, as I'm sitting here trying to be one, and
doing a great job.
Yeah, just look at 30-day term SOFR and look at the 10-year Treasury. Those are the two indexes that the vast majority of our industry is based on, whether really tied to that index or loosely, and that'll kind of communicate roughly where markets are headed.
Awesome.
So yeah,
awesome stuff. Question number 4 is, in one sentence, what's been the biggest failure that you've learnt from in your career? What would you take away?
Biggest failure? Man, I never fail. No.
Yeah,
that's not true. The biggest failure, I would say, is wasting my time on tasks and transactions, and the pursuit of information that, I guess the long story short, qualifying. In my world, you need to be able to qualify quickly, and you need to be able to look at a deal, understand it fit quickly. And so my biggest failure was that early in my career, I spent too much time chasing that pipe dream deal that, like, if everything just worked right, I know it'll happen. And frankly, every deal is that way, but you need to be able to realistically look quickly. So I'd say my biggest failure had been that, is just not learning that faster.
Yeah, I love it. But that comes with time and experience, right? Yeah, so
exactly.
It's hindsight 2020.
Yeah, and I needed that. I'm not saying that was a negative. Yeah, in the moment it felt like a negative because I felt, why is nothing working? But I had to do that in order to find out what does and make sense of it all.
Awesome. Awesome stuff, mate. Well, look, last question is, where can people reach you to continue the conversation? They want to be in your sphere. They want to have you on speed dial. Where do they go just to reach out?
Gosh, to reach out, I mean, LinkedIn's always a good space. You can certainly provide that. I can give straight up my contact information. I mean, my email address.
What's a good email address for you?
Email address is rparker@walkerdunlop.com. And, and phone office line's 949-208-8446. I mean, call me. I'll pick up. I'm not, as long as you're not trying to extend my car warranty, I'm set. So, yeah, that's the best place.
Awesome stuff, man. Well, look, I want to thank you for coming on the show today. I just want to share some of the awesome pieces of advice that you've really given out, and kudos for your first podcast. You absolutely crushed it. But taking away, I think, your in-depth knowledge. You're a guy that I obviously know personally, and you really been able to develop a good niche into what you want to become, in terms of you want to become a really good adversary for your clients in terms of the debt markets and what is the best debt to come by, and for any product from industrial to multifamily to might be mobile home parks. I also think you talk a lot about the geopolitical instability and stuff that coming in around that. How do we plan better for the future, and how does that tie into refis, and how does that tie into what we're doing from a day-to-day as a business owner when we're outgoing looking at these deals day in, day out. So I think providing that context around how you think about the deal in order to give that value back to your clients to then help them make the right decision is pretty much one of your superpowers, I think. So did I leave anything out?
No, that's it. Yeah, I try and provide the downside risk scenario and help people see that and make a decision on that.
Yep, that's awesome stuff, mate. Well, look, again, thank you so much for taking some time out of your day. Enjoy the rest of your week, and we'll catch up very soon.
You too. Thanks for having me, Reed.
My pleasure. Well, there you have another cracking episode jam-packed with some incredible advice from my mate, Ryan Parker. He did an awesome job on his first ever podcast. Definitely go back and re-listen to the entire episode because he's got some golden nuggets in there. If you do want to reach out to him, he's on LinkedIn. He's a guy that you need to have in your back pocket on the speed dial when it comes to debt markets and what's happening day in, day out. I use him probably on a monthly basis, just giving him a call, understanding what's going on when he's got his finger on the pulse. So definitely check him out over at walkerdunlop.com. If you like this show, the easiest way to give back is to give it a 5-star review on iTunes. And I want to thank you all again for taking some time out of your day to tune in to continue to grow your financial IQ. We're going to do this all again next week. So remember, be bold, be brave, and go give life a crack.